In this video, we're breaking down the new tax bill and what it could mean for you. There's a lot in this legislation, so let's take a look at a high-level summary of the most important changes so you can stay informed and make smart decisions moving forward. Let's get started. Why we're talking about this now? In May of 2025, the House passed a major tax bill, the One Big Beautiful Bill. It includes sweeping changes that may affect your retirement, income, estate, and family taxes. It was revised by the Senate, which was approved by the House. It was signed into law on July 4th, 2025. This video provides a high-level overview of what's in the bill and how it could impact you. Our goal is to help you understand the changes and plan proactively. The bill is passed, so what's in it? It makes the 2017 Tax Cuts and Jobs Act permanent, expands deductions for families and seniors, introduces new savings accounts for children, and offers temporary tax relief for workers, as well as cuts some federal spending. While many provisions are extensions of current law, several are new and time-limited. It's important to know what's permanent and what expires. Some provisions, like lower tax rates, are permanent. Others, like tip and overtime relief, are temporary, expiring after 2028. We'll label these throughout so you can clearly see which provisions may impact your planning long-term versus short-term. Individual tax changes. Income tax rates from the Tax Cuts and Jobs Act are extended permanently. Current lower brackets from 2017 will no longer expire. This prevents the automatic tax increase we were expecting in 2026. For many, this preserves a favorable tax environment. However, projections still matter, especially for Roth conversions, investment income, and retirement withdrawals. The standard deduction has increased. For joint filers, it is now $31,500, and for single filers, it is now $15,750. This larger deduction means more income is sheltered from taxes. There's also a bonus deduction for seniors over 65, the extra $6,000 per filer age 65 plus with a modified adjusted gross income below $75,000 for single filers and $150,000 for joint filers. This is a meaningful break for many retirees. It could lower taxable income and possibly reduce Medicare premiums or IRMA brackets. It does go into effect for 2025 and expires after 2028. The alternative minimum tax relief made permanent. The Tax Cuts and Jobs Act's higher AMT exemptions are now permanent. This simplifies tax planning and reduces alternative minimum tax exposure for many middle and upper middle income households. Family tax benefits. The child tax credit has a temporary increase to $2,200. This is up from $2,000 per child, and the child must have a valid Social Security number. It does expire after 2028 and then reverts to the inflation index $2,000. Families with children should plan for higher credits for the next few years, but not rely on them long term. There's also the newborn accounts, also known as Trump accounts, for babies born from 2025 through 2028. There is a $1,000 federal deposit for newborns. Parents can also contribute up to $5,000 per year of after-tax money, and it can be used for education, job training, after a certain age, your first home, or opens up for just about anything after age 30. These accounts are not tax deferred like 529s, and there are some strict withdrawal rules. Still, they represent a modest opportunity to start early savings with some government help. What these changes could mean for you: higher refunds for families with qualifying children, more support for newborns, and strict qualifications for obtaining child tax credit and newborn aid. Certainly, every family's tax situation is different. It's imperative to tailor strategies based on age, income, and long-term goals. Flexibility is key when it comes to temporary laws. Retiree and senior planning. How the $6,000 senior deduction works. It's available for seniors ages 65 and up with less than $75,000 for a single filer or $150,000 for joint filers. This phases out above those income thresholds. For clients just under these thresholds, careful planning could help them qualify. Roth conversions, realized gains, and required minimum distributions must be considered. The impact on Social Security taxation and IRMA is lower taxable income may reduce IRMA surcharges. Could also decrease Social Security taxation for some. Modeling income scenarios for retirees becomes even more critical. These deductions could provide strategic openings, but only for a few years. Some tax planning moves for retirees to consider: accelerated Roth conversions, strategic drawdowns from taxable accounts, the timing of their RMDs. Temporary tax benefits make now a prime opportunity for thoughtful adjustments. These moves could lower lifetime taxes and boost net retirement income. Medicare, modified adjusted gross income, and marginal brackets. How deductions affect the modified adjusted gross income? It lowers the taxable income. If your modified adjusted gross income goes $1 above an IRMA threshold, you move into a higher premium bracket, which impacts things like Medicare premiums, taxable Social Security, and net investment income tax. This kind of bracket sensitivity is where good planning delivers real value. $1 in income can create multiple ripple effects across tax, health, and income systems. Estate and wealth transfer. Estate tax exemption raised to $15 million. This is an increase from $13.99 million in 2025, and it's $15 million per person, and that goes into effect January 1st of 2026. This is indexed for inflation going forward. This provision benefits high net worth families. Fewer estates will be taxed federally, but this doesn't eliminate the need for trusts or planning, especially in states with estate taxes. Who benefits and who still needs a plan? Estates under 15 million, there's little changes federally, but estates over 15 million are still subject to tax. Families with real estate or business holdings should still consider lifetime gifting, trust planning, and charitable bequests. Even with high exemption, estate strategy matters. Planning isn't just about taxes, it's about clarity, control, and passing values along with assets. Trusts, gifting, and long-term implications. Annual exclusion gifts, $19,000 per person in 2025, rising from $18,000 for calendar year 2024. Consider locking in lifetime gifting opportunities under current exemptions rates. Now is a great time for a beneficiary review and trust tune-up. Use the temporarily generous exemptions to your advantage. Estate planning in a shifting landscape, high exemption may lull families into complacency. Many state estate taxes have much lower thresholds. Federal rules could change again in the future. A $15 million exemption is generous, but not permanent in political terms. Many clients still need a plan, especially in states with estate or inheritance taxes. Charitable giving and legacy planning. Donor advised funds can lock in current deduction rules. Charitable remainder trusts or CRTs may help reduce income and estate tax, and giving strategies align taxes with legacy goals. Strategic philanthropy lets clients control their charitable impact while minimizing taxes, especially important during periods of policy flux. SALT, tips, overtime, and other deductions. SALT deduction raised to $40,000. This is the state and local tax deduction cap, and it is raised from the $10,000 to that $40,000. This applies to incomes under $500,000 and does phase out gradually above that. This is one of the most contested provisions in the bill. It offers major relief for residents of high tax states. Tips and overtime pay. They are temporarily tax-free. Tips and overtime wages are a deduction that you'll take on your federal income taxes. If this applies to you, it does phase out for taxpayers with a modified adjusted gross income over $150,000 or $300,000 for joint filers. And it is temporary and applies only from 2025 through 2028. This provision could provide some meaningful short-term savings for service workers. Its short lifespan makes timing critical. Both businesses and employees should be aware of this. The auto loan interest deduction, the interest on loans for vehicles that have undergone final assembly in the U.S. becomes deductible. This applies for new vehicles purchased for personal use and secured by a lien on the vehicle in 2025 to 2028. The deduction would phase out for individuals making over $100,000 or $200,000 for joint filers. This one does fulfill a campaign promise, but has very limited impact for most people. It is still worth mentioning if a vehicle purchase is on the horizon. The qualified business income deduction has been made permanent. Pass-through deduction for qualified business remains at 20% and applies to sole proprietorships, partnerships, and S corps. This one is a win for small business owners. The increase helps reduce taxable income significantly, especially when combined with other planning techniques. 100% bonus depreciation has been restored. Full expensing for qualifying equipment purchases applies through 2029. This encourages capital investment, great opportunity for businesses to refresh equipment or tech infrastructure while deducting the full cost. Research and development expensing reinstated temporarily. This allows full expensing of domestic R&D costs, reverses amortization rule, and applies for a few limited years through 2029. Firms that do product development engineering or software creation should explore claiming this. It's valuable and often underused incentive. So what do you need to discuss with your CPA? You should ask, should you accelerate 2026 equipment purchases? Are you maximizing QBI benefits? Could R&D expensing lower your estimated taxes? Bring your tax advisor into these discussions soon. Social program changes. Medicaid work requirements have been accelerated. Work requirement timeline has moved from 2029 to 2026. 80 hours per month of work, community service, or educational programs, or work programs must be demonstrated. There are some exemptions, including pregnancy, disabilities, tribal members, and veterans, amongst others. This provision reduces federal spending, but may affect family members on Medicaid. So who's affected and what does it mean for families? Families that rely on safety net programs should prepare for tighter eligibility. Estate and business relief may expand, but income-based aid is narrowing. This slide reinforces some contrast in the bill's priorities. Encourage conversation with family members who may be affected. Let's wrap up with some final guidance. What you can do now. Review your tax projection for 2025 and beyond. Evaluate deductions, credits, and estate plans. Discuss with your financial advisor and your tax professional before year end. The most proactive clients tend to achieve the best outcomes. Let's review your plan together. Are you taking full advantage of current opportunities? Are you protected against future risks? Let's schedule some time to take a review and make sure. Stay informed and stay proactive. The law has changed. Proactive planning now avoids scrambling later. Let's keep revisiting your strategy to ensure protection. Our goal is always to stay one step ahead. Your strategy should evolve with the law to keep you optimized, protected, and confident. Thanks for spending a few minutes with us today to walk through the key changes in the new tax bill. In addition to staying informed and proactive, we encourage you to stay connected, both with us as your financial advisors and with your tax professionals, so you can make decisions that support your long-term goal. At Pulse Financial Services, we're committed to helping preserve and grow your family's wealth today and for generations to come. From all of us here at Pulse, thanks for watching.